Welcome to Two Quants and a Financial Planner, where we bridge the worlds of investing and financial planning to help investors achieve their long-term goals. Join Matt Ziegler, Jack Forehand, and me, Justin Carbonell, as we cover a wide range of investing and planning topics that impact all of us and discuss how we can apply them in the real world to achieve the best outcomes in our financial lives.
Justin Carbonell and Jack Forehand are principals at Validity Capital Management. Matt Ziegler is managing director at Sunpoint Investments. The opinions expressed in this podcast do not necessarily reflect the opinions of Validity Capital or Sunpoint Investments. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validity Capital or Sunpoint Investments.
All right, guys, today we are going to talk about something that I think is on a lot of investors' minds, and that's sort of how big or how concentrated the market has become. And the reason this is something that's front and center is, particularly for most of last year, the market was being led by a handful of stocks. Obviously, investors have heard about the Magnificent Seven, and those are the largest companies in the market today. That includes Microsoft, Apple, NVDA, Amazon, Meta, Alphabet. And those are the ones that are, and particularly NVIDIA, which just announced, I think it was their latest earnings results. It was 126% year over year sales growth, ridiculous earnings growth. And, NVIDIA is now the third largest company in the market, and it kind of has gone parabolic here. But I think for today's discussion, it's a combination of looking at this, looking how much or how large of a portion these companies are in the market today, kind of thinking about how that might stack up to where we've been historically. I'm a huge fan of Ben Carlson, who is over at Ritholtz and writes A Wealth of Common Sense. I try not to miss any of Ben's articles. Some of the stuff we're going to talk about is going to be sort of springing off some of Ben's excellent stuff that he puts out over there. And then just kind of thinking about from an actual investor perspective, whether you're an investor like we are, building investment strategies that are trying to outperform the market, or from Matt's perspective, a planning perspective and working with clients, sort of how he thinks about it, maybe some of the questions he's getting, and sort of just have a, discussion about this, because I think there are times when this becomes more front and center in investors' minds, and sort of that's where we're at today. So, maybe let's just start with what the facts are. So let's look at, and I think we're going to, if you're listening to us on audio, we are going to have some charts in here. So of course, it's always nice if we're referencing charts to pop over to YouTube, if you can do that. But we're going to start just by looking at, how big these companies are in the market today. So let's start there, guys. And I know we have the chart here, and just let's look at some of these percentages and sort of we'll start by riffing off that.
Yeah. And the first thing I think we should talk about before we get into this is there's always these things in investing where everybody's like, X is true, so therefore it's time to panic. And this is one of those things. This is this idea, there's over concentration in the market, so therefore it's time to panic. And, one of the things we want to do with this episode is get the facts on this, look at both sides of this, because almost always when you hear things like that, there's nuance to it. There's both sides to it. There's different things going on. So I think that's a good place to start. And to your point, like looking at the top 10 holdings there, we'll have them up on the screen, but you do have a lot of, you got, first of all, holdings with very high percentages. Microsoft 7%, Apple 6.22%. This is the SPY ETF we're looking at right now. NVIDIA is up there, Amazon, a lot of companies that would be considered technology companies, although with the industry reclassifications, they're not, all of them aren't technology companies officially. But yeah, you have significant concentration in the top holdings of the S&P 500. And we'll talk later about how that compares to history. But yeah, it is something that's going on right now. And it's certainly weighted in the technology area relative to other areas of the market right now. Another interesting thing that I saw here that you guys may not have, realized either is like, look at number 10 on this. And also think about what company's not here, like in this top 10 that you think would be.
Let's see, what company's not, Tesla.
Yep. So Broadcom is bigger than Tesla.
Yeah.
That's something I never would have thought. Obviously Tesla's had some bad performance recently. I guess as was pointed out to me, Matt, on the breaking news podcast, once Elon got the pay package, it was time to stop doing whatever he was doing to keep the stock up, and it's back down now. But that was interesting to me that like, I would have guessed, Tesla was still in this, and I would not have guessed Broadcom, because of the rally in those types of stocks has become bigger than Tesla.
When I look at a chart like this, or I see a table like this, and we have conversations about this stuff all the time with planning clients and certain inside of our investment committee. You can't mistake confidence for overconfidence. That's the risk. You don't just want to assume because this is historically big, and we're going to talk more about that, that automatically means bad. Because the problem is, like, you don't know it's overconfident until it's in the rearview mirror. Right now, though, take this as a symbol and signal of extreme confidence in these names. There's a huge lack of uncertainty here. And this is not to ring the alarm or say, be careful about this. But I remind you of Wile E. Coyote when he runs off the cliff. That's the thing people are going to make you scared of. And that's the thing you have to remember, too. Sometimes you Wile E. Coyote out over that cavern and you don't know it until you look down. And great companies, a lot of confidence, but Justin, why don't you tell us a little bit about what's going on historically with some of this stuff?
Well, yeah, before we move on to that, though, let's just, Jake Taylor, who we've been on the Value After Hours podcast, he had a tweet. It was right after the Berkshire Hathaway, Buffett's letter came out. And it was like, what are the chances that Berkshire Hathaway is, the top company in the S&P 500 over the next 5 years? And I thought that
he
was
even had like his thing was basically there. It's not an impossible scenario that Berkshire Hathaway will be the only $1 trillion company after a certain period of time.
Right.
That's
what it
something
was.
along those lines. I think he put it up to try to generate some controversy. But the idea is like all these companies could become not $1 trillion companies, and Berkshire could be the only one. And I don't know, Justin, do you know off the top of your head like how many of these are $1 trillion companies? Are they all?
I believe
maybe the tail end ones are not.
Yeah, I think that's probably true. Maybe Eli Lilly and Broadcom. We'll have to look, but yeah, that's a good. That is what he was kind of going after. You could certainly see because Berkshire has they have 160 billion in cash, something like that, and obviously it's a much more bricks and mortar type business. I mean, you have insurance in there, and there's obviously other financials, but the actual private part of Berkshire's business, I think they might be like the largest public employer in terms of headcount. And I know for a fact they're the largest payer of federal income taxes. So just when you look at these companies, what does stand out to me is you have all the tech there, little healthcare, and then you have Berkshire Hathaway, which is basically a conglomerate type of company.
Yeah, it was interesting. He wasn't saying, that's what's going to happen. He was saying like, it's a non-zero chance that's going to happen. And if you look back to like something like 2000, it would tell you it probably is a non-zero chance. If we had some sort of, tech-driven bear market, a lot of these names, that are above Berkshire right now, or all the names that are above Berkshire right now are tech companies. So the problem is it would be like, if you look at the decline it would take in like a Microsoft, it's not like a 20% decline in Microsoft that gets it there. It's a major, major decline. So you'd have to have a serious issue going on, but it's not impossible that you could have a situation where all these tech companies fall simultaneously and, some other more old world type companies end up being bigger. It's certainly not the probable scenario, but there's a lot of different ways the world can play out in the future.
Yeah. And don't forget the fractions of it all. Like just because they're declining doesn't mean everybody else isn't, right? Like you could have tech companies getting halved, but if everybody in the market is getting halved at the same time, these numbers aren't changing. So there's the relative differential on a tech company getting halved and, an energy company or a materials company or a utilities company at the bottom. How much do you have to go up to actually gain ground in this table when performance is relatively different? That's something as allocators we're wrestling with all the time, thinking about this stuff because correlations among sectors, yes, there's differences, but they run high when there's a nasty market event.
Yeah, you would need like a 2000 type scenario for that to ever happen. You would need a scenario where basically like your value type companies are going up during a massive bear market in tech. And, people want to, think about that because it's in recent history, but it's probably unlikely you're going to see that again. And we'll talk about some of the differences as we go here, but it's probably unlikely. But again, the thing I've learned like with Adam Butler on the podcast is there's a bunch of different ways the world can play out. It's only going to play out one way, but there's a lot of, if you think now into the future of all the potential ways it could play out, there's a lot of them. And, probably a tech driven bear market is one of them.
Yeah. And it's just like in history where we saw tech runs up, then spends close to a decade in the toilet while financials and things like that run up. And then the financials spend another decade in the toilet while tech runs up again. and I guess continues to run up. These trade-offs are important, and understanding the relative balances amongst them is hugely informative of this because it tells you how hard it is.
So let's just look at the sector chart real quick, and there's not going to be any surprises here. Information technology is 29% of the index. What I don't know, I believe Amazon might be categorized in communication services. So I think you might have to lump that in, possibly. So it would make it even, and the only point I want to make here is that, if you're buying something like the S&P 500, this is obvious, you're going to have a big allocation to technology, given the weights of these companies today.
And to your point, like sector allocation probably matters less than it ever has right now, because there are a bunch of companies that most people would think are technology companies, some of these big companies that actually are in other places. Like I believe Tesla is also in a different place. In terms of communication services and some of these other sectors that have been created, it's not the weight to actual technology is probably higher, but also like what even is a technology company these days? I mean, everybody's using technology to some degree. What is Amazon a technology company? Yeah, it is, but it also has a lot of other stuff it does. And that's the same thing with like, is Tesla a car maker or a technology company, or some of these companies that traditionally wouldn't be considered technology? Are they using technology so much in their business that they have a high percentage of technology? So to me, like this sector thing is less relevant than it's ever been, because it's very hard to classify what these companies are. But definitely these big, what people would traditionally consider technology companies are a big part of the index right now. I mean, I think that's the conclusion from this.
The GICS sector changes, and fully encourage, if you've never done the deep dive into the history of the GICS sector changes and how things are defined, wildly enlightening. Like when financials even got added to the S&P 500, for example, and all sorts of stuff like that. And yeah, Amazon, I think, moved from technology to, I want to say it's in consumer discretionary.
Yeah, that might be it. Right. I was thinking Meta. I misspoke there. I think Meta might be communication services, but
Yeah. So these GICS things, they're not, I don't want to say they're arbitrary, but to make a sector driven argument about something, you better understand all the fine details about where stuff lives, because that's a tricky piece too. And perhaps one of the most fascinating parts about this chart and looking at it, or the first chart and looking at where we are today with those stocks, is how many of these fall closer to the definition of what we consider conglomerates, or companies that spill into multiple sectors at once. And that's a really interesting way to conceptualize this whole thing too.
Do you remember when we had Chris Davis on, Justin, and we talked about sector concentration?
What was his point?
Yeah, his point was basically that he doesn't care about sector concentration. Like he looks at the different things that can happen in the world, and he looks at the exposure of his businesses to those things. But back to my original point, he was talking about like, it doesn't really tell, looking at these things and like trying to think about the risk of your portfolio, it probably doesn't tell you very much, because there's so many different types of diverse companies inside of these different sectors that you're probably better off like doing something like he does, where you're actually looking at the companies and you're looking at the risks to the companies and you're looking at how correlated that is across your portfolio. Then you're, taking these basic sector allocations and trying to figure out how they impact your risk.
Most portfolio managers in their construction are likely thinking, at least most that we talk to, are thinking more on those terms. It's less about sector concentration or sector exposure. Granted, there's lots of people who will manage a fund and use sector exposure to help make sure they, cover the beta of the S&P or whatever they're benchmarking against. But in many cases, if you're building up a bottom-up fundamental model of a company, you're thinking about what macro things hit this company in different ways. Just like for Amazon, there's a big difference between consumer discretionary and what, my wife and I order that shows up at our door every single day, and Amazon Web Services and what's going on in the cloud and all the other different divisions. These are well nuanced companies, and a good fundamental model, if that's your jam, probably you're thinking in those terms.
So let's talk a little bit about like the drivers of how these companies got there for a second. And I think there's a couple points, Jack, that you want to make. But one of the things that I was thinking is, if you think back to the first half of last year with these big technology companies, when Silicon Valley Bank was going down and you had all these hard landing type of predictions and, everyone was cautious. A lot of investors, to me at least, tell me if you guys agree with this, it's almost like they looked at these technology companies. And I think Doug Clinton and Gene Munster made this point with tech. It's almost like they were being looked at as like consumer staple like companies in the sense that they're technologies and things that people can't live without. And so to some extent, their business models and their profitability was somewhat protected even during difficult economic times because how embedded these companies are into our daily lives. So that's just one like observation, sort of looking back at last year, that I would say that how I thought, investors were kind of looking at these things.
That's such an important point because people think the word technology and they think risky sometimes. And, back in 2000, that was true. But technology, a lot of these companies are not the up and coming companies anymore. Crypto or whatever is where the high risk sits or whatever it is these days. These are legitimate businesses. And remember, we had a podcast guest on who talked about this idea that they find protection now. Like when they want to find protection for tough times in their portfolio, they don't find it in the balance sheet of a company anymore. They find it in the quality of the business. And they were talking about how that's so important with the Microsofts and the Apples of the world and why they do well now in these risk-off types of events, because these are solid businesses. Like, people need Apple products, at least for now. I mean, who knows 20 years from now if someone's going to supplant Apple, but right now people need these products. And so that is so important, is like thinking about this. Don't think about this from the perspective of technology and risky, think about the quality of the actual businesses themselves.
I think so much in terms of, so when people are worried about a recession or worried about a crisis or whatever else and start to reallocate based on these shifting sands of confidence, a lot of times what you're looking for is what's scarce. And if we're scared about a recession, we're usually scared about the consumer or 18 other, Silicon Valley Bank or whatever the last giant major fear was, or the Fed. And you think about what's scarce. And when things are scarce, you look for where, like in a recession, growth is scarce. So you look for places where there's still growth. And what's amazing is what we think of as these technology companies, in many cases, for the better part of the last decade plus, post-financial crisis, these have been the shining beacon conglomerates that have not had a problem with growth as a scarcity. Look no further back than the pandemic and everything that happened. It's like, okay, well, everybody needs to stay at home, so everybody needs more internet. Everybody needs to reshift their spending and get their Amazon deliveries. So there's that on the consumer discretion shift. These are growth scarcity stories that have just become funneled further and further, good corporate capital allocation strategy, into a handful of names. Jack, to your point, they've become safer in the sense that people have become more confident in this is where you can go and find growth when it's hard to find it anywhere else.
Yeah, I didn't answer Justin's original question because I never do, and I always ramble off on some tangent. But
as you should.
To your point, what Matt was saying is like these businesses are a big portion of the S&P. A large driver of that is they've done really well. These are really good businesses. These are high margin businesses. These are businesses that make money, and they're growing, at rates that you typically would never see on companies this big. They're sort of challenging the idea that when you get to a certain size, you can't grow at these rates anymore. We're seeing like technology companies, or I don't want to use the word technology because I'm kind of contradicting myself earlier, but these types of companies, we're seeing them growing at rates you wouldn't think they'd be able to sustain. So the biggest driver to me of why they're such a big portion of the index is because their businesses are doing really, really well. There's obviously other things that are peripheral to that. We had Mike Green on recently, and certainly I think the rise of passive investing and the fact that there's a lot of money going into indexes that doesn't care about fundamentals, and they're investing most of that money into these big companies, and that their liquidity doesn't scale with their market cap, that is probably contributing to this. To me, I would consider that like a secondary contributor to this, but I still think the primary contributor to this is that these companies are doing well and their businesses, deserve to be big percentages of the market. We can debate what percentage it is, but they deserve to be big percentages because they've good businesses.
And everything's running into them. That's the Mike Green passive argument, which was a fantastic episode, by the way. I'm really embarrassed that I heard that after we did the David Einhorn episode because of how good it was. But yeah, so what? So there's a passive tailwind into these things. These are still big companies putting up big numbers. And it's like, you can get upset. Like I can be upset that I'm not the top center in the NBA, but like the results show I'm not in the NBA. I'm not that tall, not even that good at basketball. So hence stock 499 in the S&P. If there even is a 499 stock today, I don't know if there's 500 names in the index today. But versus, number 1 through 10, who are just crushing it with their numbers.
So before we talk about history a little bit, and don't bring up the chart yet, guys, I have a question for you. And this is referencing back to a 2019 Jason Zweig article. So how many stocks going back to 1926 do you think have had the highest valuation or been the number one rated stocks in terms of market cap in the US?
How many stocks, like how many total companies have?
Yes.
Have been the biggest
Have been the biggest company.
And how many years are we doing this over?
Going back to 1926.
Couple of years. Couple of years.
We can get this
No.
chart. We're gonna
No
cheating.
That's
No
fine.
cheating.
It only gets
You
me back
gotta
to
wager.
1980, though. That doesn't help me going back further than that.
I mean, I want to say 10 just because we got about 10 decades in there and it feels like these things flip every so many years, but I'm expecting to get fully slapped by some gross small number.
Is this like the Price is Right, where I like have to get the right answer
Yeah,
without going over? So if Matt
Sure.
says
Pick,
like 10,
if you pick 9,
something
basically
like
you're
that?
winning right now.
Or is it 11? Is it 11 I need to say, or 9? I always forget the way it works.
That depends
You're
which
not
way it
supposed to go
skews.
over? I don't even know. So yeah, I'll go with that. I'll go with
Well,
11.
well, you're not going to win because Matt nailed it. But
He did?
yeah,
Seriously?
great job. So yeah, so there's 10
Alright,
stocks.
Sure.
They are Microsoft, Apple, Exxon, General Electric, Walmart, Altria, which was formerly Philip Morris, IBM, Dow DuPont, General Motors, and AT&T. And
Is it
I always,
split? I know you're going to show the
What?
chart. Is it split by decade or is there like trading off and on? Like how?
well, yeah,
That
let's
really
look at-
was just a dumb guess that I
Well,
had no.
yeah,
no
let's look
information
at. I mean, no, it's you kind of have these clusters, like IBM, as you guys can see, in the 80s and the 90s, and then General Electric, as we all know, in the 90s and the 2000s. Remember Jack Welch, and then ML and their roll up, and Welch with all his management books and stuff, and then Exxon pops in there, and then it's been Apple since 2015, and now Microsoft is barely edged out Apple in the current shape, current day. But one of the things that I always love that Jason Zweig article, because in I think IBM, or no, I'm sorry, AT&T might have been, where's the statistic in here? I'm trying to find it. At one point, AT&T was 13% of the total US stock market. That was before it was,
pre baby bells.
yeah,
and
before it was broken up and stuff like that. And I think like when you look back in the 40s and it had like a massive long run of just being the most dominant company in the country from a market cap perspective. And so anyways, we'll put a link to the article is titled "What Amazon's Rise to Number One Says About the Stock Market." He kind of looks at the history of sort of the market and sort of what we're talking about.
I'm still recovering, by the way, from the fact that like Jack Welch was not a good CEO. Because like when I was growing up, that was like the huge thing. Everybody, like every book was Jack Welch. Like everything was like he's the greatest thing of all time. And now, like,
Well,
I think
as
we
a
found in
fellow
retrospect
Jack,
he was not
you
what we thought he was.
As a fellow Jack, you must have felt like this is like
I
your
know.
birthright.
I was very upset by this. Like I was reading his books when I was like, coming out of college, like all the stuff I had to learn to run a great business, and then suddenly he's not good.
Oh man.
It was a big adjustment for me. But anyway, we don't need to get my we don't need
But-
to get
but-
kind of
but-
deep
but-
into the
yeah.
track right now.
But I think the key takeaway lesson for me, there's two things. One, it's no company is going to be on top forever. It's just not. I don't believe that that's possible. There's always the competitive. It's like the Joseph Schumpeter, the perennial gale of creative destruction. These companies are highly profitable, but their businesses are always coming under attack, and so is their profitability. And the other thing is, this is one of the arguments for why passive investing sort of can work for a lot of people, because you just naturally, you're going to get exposure to the companies that are growing, the companies that are winning, the companies that are becoming more profitable. Because ultimately, Jack, back to your point, if fundamentals matter, which they should over time, those companies are going to rise to the top of the index and the other ones are going to fade away. So I don't know what you guys think about that stuff, but that's kind of where I'm at.
Yeah, there's a bunch of different takeaways from this that are interesting to me. Like in terms of looking, we should probably put up the chart now for the top 10 holdings in the S&P over time. Like you said, I mean, the companies, it's interesting that they'll persist for a while. They won't persist for that long. I mean, IBM made it for 3 decades. It was, not 3 decades, basically 1 decade. General Electric was on here 3 times in a row. Apple's been on here for a while. It's interesting. And, also going back to our original point, and I don't know if we said this explicitly, but it's like 32% right now is what the top 10 holdings are of the S&P 500. So, as you look at this chart, you can kind of compare it to history. And it's not on here, but there were periods where it was more concentrated. Like the Nifty 50, I believe, was around 40%, give or take. So we are not at unprecedented territory or the highest in history, or, if you see any of that stuff about like, build a bunker in your backyard because it's all over. We're not at that, but we are very high, relative to some of these other things. And, what's interesting as we think going forward is, first of all, like look at some of these companies. I mean, a lot of these companies don't even exist, right?
Look at 2000. I mean, you have AIG in there. Cisco's not, I don't know what Cisco's weighting is now, but it's, you can take any of these lists and you can see companies that have, fallen off or maybe aren't even around anymore.
Yeah. And that's the hard thing about this is you think like in the moment today, like if you look at the list of, this is from 2023, this is from Ben Carlson's piece, but if you look at those names, like you'd have a hard time coming up with one of those names that you think is going to be like way, way smaller in a decade. I mean, all those names have a pretty good case. I mean, maybe Tesla, but so they all have a pretty good case that they're a pretty solid part of our economy. And you should be going forward. But did you feel the same way in 1985? When you looked at IBM and Exxon and General Electric
right.
and, DuPont and whatever, did you feel the same way then? Sears, by the way, a great example, like that didn't end well. So like, it's just interesting to think about as we think about where we are now, like trying to put yourself back in those times and say, would I felt the same way about those companies that I feel about the Apples and the Microsofts of today?
And how many times do you think, and granted, I don't know this, but it's when you see these names like leveling off, sometimes it's just because the person lower just was rising faster than the one who was on top. Like these aren't all like, it's not the tree grows to the sky. That's one rule. Trees don't grow to the sky. You get to a certain limit, there's natural limits. But then the other reality here is it's not like you get to the top and then you go off a cliff. You don't fall just because you had some catastrophe. You don't get AIG'd, to use like the financial crisis thing. A lot of these companies, they just stopped growing as fast as whoever else and somebody else caught up with a new trend or whatever else. It doesn't mean that these companies were killed. See AT&T as just one of a million examples in here.
And that's another interesting thing on this chart. Like a lot of these companies are still around in some capacity. I mean, Cisco is not one of the biggest companies in the S&P 500 anymore, but it's still there. It's still running a profitable business that continues to exist. To your point, they just got passed by other people. So it's not always a story of, this ends in disaster. A lot of these companies are still here, and the Procter and Gamble, a lot of these companies are still here. They just aren't the biggest companies. Other things changed in the economy and other bigger companies took over.
There was a Sears pretty close to my house, and the place was just a dump. And it's just,
dare you?
Was this towards the end? This was towards the end.
This was towards the end. But then what they did is Sears had all those like great prime locations. And so I don't know if Eddie Lambert was in there or something like that. And then he kind of like was trying to repurpose. And now the plaza is like amazing. There's like a Saks Avenue off thing in there. There's like a marketplace thing. It's like they've done there's an REI that they put in. So it's
I
really
know what
nice.
you're talking about.
Yeah.
That turnaround in that lot, it was literally crazy to watch in Connecticut as that got re-engineered. Which a lot of Sears did that when they were at least in a hub where there was commercial activity. There's a lot of other ones.
Right.
You can go 20 minutes up the road on the highway from where you're talking about that Sears. And I could show you another one that's basically one of the many dead malls of America that miraculously was basically kept open by a Radio Shack and then a GameStop.
But I think it's a good
too long.
In thinking about what Sears used to be or what JCPenney used to be in this country, that used to be like Friday nights, families would go in the 50s and 60s, they would go to Sears as a family, they would shop, and it just goes to show how much consumer behavior and trends and things can change over time. Now we're all sitting in front of our computers, basically ordering everything off Amazon, and our kids have their own accounts and, no one's doing family shopping events.
But it's a new conglomerate. It's still a conglomerate. We have a new version of it. Just saying.
You're bringing back big memories from my childhood because like one of my favorite things to do was when it became time to replace the appliances in the Forehand household, we would pack the whole family into like the Volvo 740 turbo or whatever it was. We would all head down there And like, I could look at like 4,000 refrigerators, like all next to each other and be like, oh, let's get this one or let's get this one. Like as much as that makes me weird, it was actually a fun thing to do.
Well, it's a fun thing to do. It was a brilliantly executed strategy. And yeah, I've got good memories of going into Sears.
Do we want to hit on the, Jack, I think you had kind of started to look at this sort of the relative fundamental weights here without getting too specific. Just, was there anything that you took away from that?
Yeah, no, the idea basically is, one of the ways to say, is this justified, is to say, all right, what's the market cap weight of these companies in the S&P? And then what is the weight on fundamentals? And depending on which fundamental, it can be different. But, the numbers based on fundamentals are in the teens or in the 20s. And the actual weights are in the 30s. So from that perspective, these companies are trading they're trading at a premium to their fundamentals. But the one thing to keep in mind is the part that's missing from those fundamentals is growth. So if you look at like a GARP type thing, companies that are trading at higher growth rates deserve to trade at premium multiples. And so these companies are also growing at a faster rate. If you took the growth rate of these 10 companies against the growth rate of the 490, that growth rate is higher. So they deserve to trade at a premium. So it's beyond me to argue like whether we're at the right place or whether these are overvalued by a lot or anything. But the point is that's kind of the way to look at it is to say, what are the fundamentals? And when you look back to, we talked about 2000, that's where you see the big difference here. Like look at Cisco's multiple in 2000 relative to like NVIDIA's multiple right now. NVIDIA trades at a premium multiple, nothing like that. Nothing at the hundreds of times, earnings or whatever Cisco was trading at. So it's just important when you compare across eras, you can ask that question. All right, we've had these different levels of concentration, but what were the fundamentals looking like behind the scenes in those different eras? And in a time like 2000, you saw really extreme concentration, relative to the fundamentals.
You need that reminder, Jack. It's got to be tied back to the fundamentals. The fundamentals have to be tied to some story that's carrying this thing through on why people should care. And in many cases, we look at it through the growth lens and we say, if growth is scarce, because in a post-pandemic world, growth was scarce. We all wondered where it was going to come from at zero interest rates and all that stuff. GARPier stuff tended to work better. That got awarded with higher multiples. We haven't really moved on past that yet. And it's as true with companies as it is with anything else. Let me remind you of the other Cisco and his wonderful hit, the Thong Song. There was a place and time for the Thong Songs, but that ship eventually sails. And you just got to be ready for that.
I was wondering what you're going to prepare for this episode, Matt, and that was not where I thought you were going to go. So
that is not what I even thought to prepare for this. And I'm a little let down in myself.
This was off the top of your head then. This was not what you prepared.
This was random chaos. And you're just lucky I couldn't work a Cisco Food Services in there too.
One of the...
Oh, go ahead, Justin.
I was just going to say, one of the, possible challenges for active investors that are trying to, construct portfolios that beat the market is, if you have shunned these companies and haven't had them in the portfolio, you've probably largely trailed the index. Maybe not in all cases, but it's just tough. If you don't have some exposure to these really top performing stocks, there's a chance that, you're going to be trailing the market. And then that has a whole set of, for active managers sort of challenges in terms of client retention and growing assets and things like that. So that is just something that, and listen, the index is for and this goes over time. The index is very hard to beat net of fees for most managers, but I think this concentration sort of highlights that.
Yeah, it's been a challenge for both active managers and factor investors like us and everything. Like, go back to those weights we showed at the beginning. Like, come up with a factor that gets me to there. Like, there's one factor you're going to come up with: market cap. And not anything else, like not quality or value or momentum.
Momentum might have got you there. Momentum might have kind of got you there, though.
Well, not really, because momentum is, 1 year momentum. So like, as much as these companies have had sustained momentum over a really long period of time, they've been in and out of momentum portfolios, during that period. So like, unless you use like some crazy long-term momentum or something, which is not what works academically, a lot of momentum portfolios, like the momentum funds we look at, wouldn't look at anything like this. And they also typically wouldn't overweight the biggest companies. So even if they had the momentum funds, had the Microsofts and the Apples in there, they're probably equally weighting them. They're probably not, holding 7% in Microsoft.
Well, yeah, to that point, you wouldn't have been in these at the end of 2022. So a momentum strategy would not have had these and would have had to chase them back in as they performed in 2023. So that's a good point.
Yeah, and it was interesting. Like I asked Mike Green on the episode, like if I wanted to, because I'm always doing the factor nerdy stuff. I'm like, if I want to construct a factor to say, all right, if this passive investing is influencing the market, and I want to say like, what are the companies that have the most flows relative to their market cap, relative to their liquidity? Could I do that? And could I come up with something better than a market cap weighted index? And his answer was pretty much no. By owning a market cap weighted index, you're owning the companies that are benefiting the most from these flows. You can't break it down any further using like some detailed liquidity metric to get there. So this is just, in order to match these indexes, you pretty much had to own them, or you had to be one of these tech investors who, really focused on these big name companies and didn't own the rest of the index. And, those guys are outperforming.
Just curious if you have this, great. If not, no big deal. What's the percentage of Apple in Berkshire Hathaway's investment portfolio?
Well, I think he owns, let's see. So I can tell you real quick. There's a, CNBC has a Buffett tracker. So you can see, Berkshire Hathaway. You can see.
Zach, can I do like a headline for this now? Like Warren Buffett is the true beneficiary of passive flows or something?
This is where I'm going with this.
Well,
so we take it there.
Might actually hit really well on YouTube.
So let's see. So Buffett has a 163% position, $163 billion position in Apple. His total equity portfolio is 369. So 160 over 369 is what? 163 divided by.
So 43%.
369. So of his stock portfolio, and then Berkshire's market cap is basically 890. So of the 890, 163 is in Apple. So about a little over an eighth of Berkshire's overall total market capitalization is Apple stock.
Which I find fascinating. And I think this is important to remind people too. Like if Warren Buffett is the patron saint of value investing and he stands at odds with passive investors, he's got a 43% portfolio allocation to Apple on that math approximately. I'm stating this right, guys, right?
Yeah, say it again.
I know. Yeah. I think, maybe you do it relative to the market cap, but he has a massive, massive position in Apple, far bigger than the index does.
Far bigger than the index. And hey, financial advisors out there, if a client came to you with a 40% position in one stock, what are you telling them? And then do you want to fight the passive market fanboys, the Warren Buffett fanboys, or something else? It's really interesting to think about this stuff and how it evolves, even in, Berkshire Hathaway, which is on that top 10 list.
Nobody's talking about the risk of overconcentration in Berkshire Hathaway. Everybody's talking about the risk of overconcentration in the market.
Right.
But like,
who's lecturing Warren on this? Who's lecturing Warren on, you got too much Apple, buddy. How dare you? Is this Jim Cramer? Am I diversified or what?
And he just doesn't care. I mean, Buffett does his own thing. He could care. You could lecture him all day about his overconcentration in a position. He could care less.
Well, back to the idea. If you, and I'm using understand in air quotes. If you understand the reason you're invested in something, you don't have a crystal ball about what's going to happen next. But if it's okay for Warren Buffett, just digest that.
The other thing with these big companies, and it kind of goes back to the Einhorn thing a little bit, but I'm thinking of Buffett and Apple. One of the things that he's highlighted a lot with his investment at Apple is that, the company is, I don't know if this year, but the company has over the last, let's say 5 years, or maybe longer than that, been buying back its stock. And a lot of these companies, and I'm just trying to think of, I think it was Jim O'Shaughnessy we had, I don't know, someone we've had on the podcast has talked about like some change in the 1980s, I think made it easier for companies to buy back their stock. I think there's something like that, like something in the legislation or something in the tax code or something. I don't know exactly what, but I'm just wondering if that is also a big difference between, what has happened historically with some of these companies and what is happening now in terms of just more and more companies buying back their stock and how that plays into, shareholder value. I don't know. Maybe that's a discussion for another day. Just thinking out loud here.
The shareholder yield episode. Yeah, I think that's interesting, but that's another one that it evolves over time. There's no broad brushstroke of where no matter what, when we're comparing top 10 market cap stocks today, against 5 years ago, let alone 50 years ago. There's no apples to apples comparison here. There's just no way to truly do that all the way. All we can say is these are the 10 biggest companies per this unit of measurement. It doesn't tell us a heck of a lot of what they have in common. And yeah, maybe for a future episode, we'll play like, what am I describing? Is it Sears or Amazon? And I bet I could go down a list and it would be astounding how many things would surprise us that you wouldn't see coming just because the world keeps changing.
And just one other point on overconcentration before we move on. It's when you talk about the issue of overconcentration, you also have to talk about the issue of what are you concentrated in. So if I want to have a 7.1% position and I'm worried about the risk of my portfolio, I'm probably better off having Microsoft and Carvana. So it is different. Like these are the biggest companies in the economy. And that doesn't mean there's not a risk of overconcentration, because there is. But if I've got a bunch of random small cap, companies losing money, and I've got 32% in my top 10 holdings, that's a different portfolio than these companies that are like the central part of our economy.
So Matt, I'm a client. You're managing my portfolio.
You're not Warren Buffett, are you?
No.
Okay, good.
You're going to tell him to reduce his concentration? Is that your first thing?
I was getting scared of that. I don't want to tell Uncle Warren that.
No, I come to you and I say, I want to buy, I want to buy the S&P 500, or I want to buy the NASDAQ, because these have exposure to what I feel are great companies. And maybe I don't see them in the portfolio now. Like, how do you think about this from a client planning communication perspective?
Goals first. So no matter what, unless you're coming to me and we're on an investment advice only contract where we're saying, what are we trying to do for our pension portfolio or whatever it is, we're having a conversation about what, why, and how you want to do this thing. And I'm sure is no surprise, we have clients who have concentrated positions in many of these top 10 names because they've been massive beneficiaries of owning them for the last 3, 5, 10, 20 years in some cases. That's one of the things that happens when you invest in individual securities. Sometimes you get, and we'll give you credit being really smart, but you get really lucky on top of being smart enough to have had these things. What that introduces is, okay, what do we want to do with it? And the ongoing theme of this, whenever we talk about it from the planning lens, is it's consumption or a gift. If you have more than 10% in a single security name, usually we're going to have a conversation about, okay, with the other 90% of your wealth, or more or less, whatever it is, what portion of this do we need for consumption? What goals do we have to match against this? And what risks does the concentration in the portfolio create that might endanger some of those goals? This can happen in an individual stock. This can happen. It's very common to see this happen with real estate, probably more common than with like an individual stock, or sometimes in a cluster of stock. What's most important is start to layer together. We'll take it all the way back to that portfolio manager question that you brought up earlier about understanding like the layering of the risks. I'm going to ignore what sector I have, but I'm going to understand the layering of risks. What if I have a giant long position in Amazon, NVDA, and Exxon, and I have loans out against those that are providing bridge financing to my company or my real estate portfolio? This meshing of the risks and understanding what type of a decline does what for my ability to consume or use this money for what I want to do, that becomes the bigger issue. So there's nothing wrong with owning these things. There's even nothing wrong with having a giant concentration of some of these things, so long as you've done the rest of the planning around it. And if one of them is going to puke on its shoes or fall out of bed or whatever's going to happen, and it will happen, what are we going to do about it? Likewise, just as a reminder, and I feel like we've been talking about this for years too, like these things are going to evolve. So even if you have the concentration today, doesn't mean they don't get spun out into 10 different things later. You have a giant Google position. What happens if all of a sudden in 5 years we have Google and YouTube? What happens if Facebook on that chart there changes their name to Meta? What happens if I'm in Drew Hill and Drew Hill disbands and Cisco goes off and writes the thong song? Get your exposure, know why you're doing it, and just know what you're sticking with and what those risks are. That's the conversation we're having.
I didn't even remember Drew Hill. That's a good
Oh,
analogy.
we get deep cuts here. Deep
Yeah, we
cuts.
do. What
Yeah,
interests me too on that, Matt, is this idea that, if this does accelerate, I wonder how planners will think about it. Like, it's an unlikely scenario, but if we're looking at it 5 years from now, and we're like 60% of the S&P is in 10 companies or something, like, I don't think that's likely to ever happen. But if it did, it would be an interesting risk that's out there that is like a risk we haven't really faced, which is people who are real in the S&P 500 who are doing the right thing by indexing face like a level of overconcentration risk that typically would be reserved for other people running like these focused portfolios. And like, how do you think about that? I just think it'll be interesting to think through if we ever got to that, although I doubt we're ever getting there.
I doubt we're getting there. I'll put this out there too, because so legitimately, since 2019, we've been talking about the Nifty 50 like ad nauseum with clients. Since 2019, we've been talking about, remember the Nifty 50, remember the Nifty 50. You can't just pay for growth at all costs. At some point, it turns around to bite you. And guess what? We're in 2024, and this was exactly the thing you should have kept doing all the way through the pandemic. If we get to that point, and every financial planner can understand this, I would think, if you have people that have been investing for some period of time, if people are just starting off and have never invested a dollar, it's a different. But if you're serving people, I would say like in their 40s and up, and certainly in their 50s and up, whether it's in a passive fund or their Berkshire Hathaway position, or they've gone out and they've bought some of these companies because they thought Apple was a good idea 10 or 20 years ago. They're out there. If we get to that position, Jack, where everything keeps lifting more, that rising tide continues to lift these boats, there's also a heck of a lot more profits to do something with. One thing I know for sure, the older people get in life and the bigger these concentrations get, or the bigger these things happen, the more they want to plan on what to do with it. And that might be how to title it to do an efficient estate planning transfer to their kids because they want to gift it, or a charity because they want to send it away while it's at a high watermark and not pay the taxes. But if it keeps going up, it just changes the nature of the planning conversations. It doesn't change the nature of portfolio construction or the logic or the conversations that need to be had.
And the other point too is we don't know where we are in the cycle with this. And that's so important. And I want to put up this NVIDIA versus Cisco chart quick because it's just interesting. I hate these charts, by the way, that compare like the past performance of one stock and put the present for another stock on there as if they mean anything. But what this chart does get at is this idea, and we're about to have Doug Clinton on our other podcast on excess returns to talk about the idea that he thinks we're in like 1995 in terms of like a comparison with the dot-com bubble with AI. So he thinks we're at the beginning of this. It just shows that, you think about how much NVIDIA's run up and you compare it to Cisco back then, and it could be early stages here. It also could be the end of the road and it could roll over tomorrow, but it's just interesting to think there's a lot of different paths here. And just because we have overconcentration or whatever we have doesn't mean it's not going to get a lot worse. It also doesn't mean it's not going to go the other direction. We really don't know, but it was just interesting for me to look at that chart because it just tells me like how out of hand this could get. A small, obviously low probability type thing, but these things could get way more out of hand than they are now.
Asking for a friend, end of the road. Was that a Boys to Men reference I just caught?
It was not, but it would be my first actual pop culture reference that I ever came up with in the podcast if I did. So maybe I could edit it back to make it look like I did say it that way.
Well, I think that was earlier 90s and 95, but I think these scenarios and thinking through this stuff in this way is super, super useful. And the bigger way that I think about all this is the thing I had in my head before we recorded that wasn't Cisco the rapper in the thong song. I keep going back to that. So you guys, you've seen The Magnificent Seven, the theme song, you've seen the movie, not the new one. There was like a 2016 version. Not talking about that trash. You've seen the 60s movie, The Magnificent Seven?
I haven't.
Your child. I am hopping in the DeLorean and coming to find you guys as kids with a copy of this movie because it's so friggin' good. It's such a great movie. You got Yul Brynner, Steve McQueen's in it, Charles Bronson is in it, a whole cast of others. And the premise of this movie is like this village is getting, attacked by the bad guys. So the village is getting attacked. They go ask for help. They find this ragtag groups of like drunks and bandits and like, pistol men, and they're the Magnificent Seven. And so these guys come in to basically save this village from these like evil bandits. But in the mix of it all, they kind of get like housed, and they protect the villagers. They teach the villagers to like protect themselves. but a couple of them die. Like it's rough. It's rough. And in the parting shot of the movie, the main guy in the village says to the departing like heroes who now have lost friends and everything else, he's like, the only people who really won in this thing was the village. The Mag 7 lesson is like these 10 companies or these Mag 7 stocks we're all obsessed with right now, they're not like the winners. The winner is us as investors. Like you have to be in the village. Don't be the bad guy. Don't be out there shorting all this stuff, but you also don't have to be the Mag 7 and taking all names. The village is what wins by not doing stupid stuff.
I was thinking, Matt, one could look at the host of this podcast as a ragtag group as well. So that might be another analogy to what you're doing.
I mean, I like to think of you as Yul Brynner with the shaved head. And
Would you be Charles Bronson or?
I'm Charles Bronson. Justin is without a question Steve McQueen in this case.
Oh, love it.
Yeah.
I got the short end of the
All
stick.
right.
Hey, you didn't get Charles Bronson.
All right, guys, good stuff. I think that's a good way to conclude it. Thank you guys for watching, and we'll see you next time.
Hi guys, this is Justin again. Thanks so much for tuning into this episode. You can follow Jack on Twitter at @PracticalQuant. You can follow me on Twitter at JJCarbino, and follow Matt on Twitter at @CultishCreative. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. Also, if you have any ideas for topics you'd like us to cover in the future, please email us at excessreturnspod@gmail.com. We would like this to be a listener-driven podcast and would appreciate any suggestions. Thank you.